What you are looking at in the silver market right now is not just another pullback or another reaction to inflation data. It is a deeper structural mismatch that has been building quietly for years, and most of the visible price action only makes sense once you understand what is happening underneath it. There is one number that captures the entire situation more clearly than anything else: 46.3 million troy ounces. That is the projected global silver supply deficit for 2026. In simple terms, the world is expected to consume 46.3 million ounces more silver than it produces in that year alone. But the real story does not come from a single year. It comes from what has already been happening repeatedly over time. This is expected to be the sixth consecutive year where silver demand exceeds supply. 6 straight years of structural deficit conditions in a market that is normally expected to stay balanced over time. Even more important, the projected deficit for 2026 is around 15% larger than the previous year, which suggests that the imbalance is not stabilizing but gradually expanding instead. At the same time, the price of silver is trading around the low 70s, after experiencing a sharp wave of selling pressure driven by macroeconomic forces. Inflation readings have remained elevated, particularly in producer-level data, which has kept concerns about persistent cost pressures alive in the background. The US dollar has strengthened during recent sessions, and geopolitical tensions linked to energy supply routes have added another layer of uncertainty for global markets. All of this has created an environment where traders have reduced risk exposure, leading to multiple sessions of selling pressure in silver. This creates a natural question that sits at the center of the entire discussion. How can a market that is structurally short by tens of millions of ounces continue to trade at current levels after a strong short-term decline? And more importantly, what happens when the difference between paper pricing and physical reality becomes too large to ignore? That tension is what defines the current phase of the silver market. To understand why this imbalance matters, it is important to step back and look at how silver is actually produced. Many people assume silver mining works like a direct response system, where higher prices automatically lead to higher production. In theory, that is how commodities are supposed to behave. In reality, silver operates under a very different structure. The majority of global silver production does not come from dedicated silver mines. Instead, silver is mostly produced as a secondary output from mining operations focused on other metals, primarily copper, zinc, and lead. This means that silver is not usually the primary economic driver behind mining decisions. Companies do not typically open or expand mines based on the silver price alone. They base those decisions on the economics of the main metal they are targeting, and silver is simply recovered as a byproduct during that process. This distinction is extremely important because it limits the normal supply response mechanism that exists in most commodity markets. In a typical situation, rising prices encourage producers to increase output, bringing more supply into the system and eventually restoring balance. But in the case of silver, that feedback loop is significantly weaker. Even if silver prices rise sharply, it does not necessarily lead to a proportional increase in production because the mining activity itself is driven by other metals. As a result, the supply side of the silver market is structurally rigid. It cannot quickly adjust to demand changes in the way that more flexible commodities can. That rigidity is one of the key reasons why deficits can persist for extended periods without immediate correction. And over time, that persistence has a cumulative effect. When demand exceeds supply year after year, the gap does not simply disappear. Instead, it is filled using existing above-ground inventories. These inventories include stored silver in vaults, exchange warehouses, and commercial stockpiles held for industrial and investment purposes. This stored metal acts as a buffer that allows the system to function even when production is insufficient. However, that buffer is not infinite. Over the past several years, a significant amount of silver has been withdrawn from above-ground storage to meet ongoing demand. Estimates suggest that hundreds of millions of ounces have been drawn down since 2021 alone. This represents a substantial portion of the available inventory pool and highlights how dependent the market has become on stored supply rather than fresh production. The important implication is that inventories are not just a passive storage mechanism. They are actively being consumed to maintain balance in the system. And when inventories decline, the ability of the market to absorb future deficits becomes increasingly limited. In other words, each year of shortage reduces the safety cushion for the next year. This is where the current situation becomes more sensitive. A projected deficit of 46.3 million ounces does not exist in isolation. It is layered on top of several previous years of depletion. That means the system is not only dealing with ongoing shortages, but also operating with reduced reserves compared to the past. Naturally, when investors hear about structural deficits like this, a common question arises. If the supply situation is so tight, why does the price not immediately reflect it? Why does silver still experience sharp declines during certain periods, even when long-term fundamentals appear supportive? The answer lies in the separation between two different pricing forces, the paper market and the physical market. The price most people see is primarily driven by paper trading activity, particularly futures markets. These markets are heavily influenced by macroeconomic expectations, including interest rates, inflation data, currency movements, and geopolitical developments. Traders and institutions adjust positions quickly based on new information, which can lead to strong short-term volatility in either direction. At the same time, the physical market operates on a slower and more structural timeline. It reflects real-world consumption, industrial demand, manufacturing needs, and inventory flows. Physical demand does not respond instantly to daily macro headlines. Instead, it evolves gradually and reflects underlying usage trends across industries. When these two systems move in different directions, price can appear disconnected from fundamentals in the short term. Paper markets can push prices lower due to macro pressure, even while physical inventories continue to tighten. This is not unusual in commodities, but it becomes more important when structural deficits persist over long periods. Eventually, however, these two forces cannot remain separated indefinitely. When physical constraints become strong enough, they begin to influence pricing more directly. The timing of that adjustment is unpredictable, but the relationship between physical scarcity and price tends to reassert itself over longer cycles. In the current environment, macroeconomic forces have temporarily taken control of price direction. Inflation data, dollar strength, and interest rate expectations are shaping sentiment and positioning in the short term. But beneath that volatility, the structural supply picture remains unchanged. The deficit is still present, inventories are still being drawn down, and production constraints are still intact. This creates the foundation for the next phase of the market discussion, which involves demand shifts, industrial usage patterns, and how certain sectors are adapting to changing price conditions. One of the most important areas to understand in this context is solar manufacturing and industrial silver consumption, because it plays a significant role in the overall demand structure and helps explain why the long-term picture is more complex than it appears on the surface. Industrial demand is where the silver story becomes more nuanced, because it is also where many simplified bearish narratives tend to break down under closer examination. One of the most frequently cited developments in recent discussions is the reduction in silver usage within solar photovoltaic manufacturing. On the surface, this is often interpreted as a clear demand shock, with the assumption that lower silver intensity per solar panel automatically translates into weakening overall consumption. However, the reality is more layered and depends heavily on how industrial adaptation actually works in response to sustained input cost pressure. Solar manufacturers rely on silver paste as a key conductive material in photovoltaic cells. This makes the solar industry one of the largest industrial consumers of silver globally. When silver prices rose significantly earlier in the cycle, production costs for solar manufacturers increased as well, creating direct pressure on margins. In response, the industry did not simply reduce output or absorb the cost passively. Instead, it initiated a broad engineering adjustment process aimed at reducing the amount of silver required per unit of production. The result of that process has been a measurable reduction in silver usage per panel, with reports indicating a decline of roughly 19% in silver intensity. At first glance, this figure appears to represent weakening demand. But what it actually reflects is technological optimization driven by necessity rather than choice. Manufacturers were effectively forced to innovate in order to maintain profitability under higher input costs. This distinction is critical because it changes how the demand narrative should be interpreted. A reduction in material usage per unit does not automatically translate into a reduction in total consumption. It only reduces consumption if production volumes remain static or decline. In the case of solar energy, the opposite trend is taking place at a broader level. Global solar installation capacity continues to expand as part of long-term energy transition strategies across multiple regions. Even if each individual panel uses less silver, the total number of panels being produced and installed continues to rise. This means that overall silver demand from the sector does not necessarily collapse. Instead, it shifts into a new equilibrium, where lower intensity per unit is partially or fully offset by higher total deployment. What is important to understand is that the 19% reduction in silver usage likely represents a significant portion of what can be achieved under current commercially viable technology. Further reductions become increasingly difficult without more fundamental changes in photovoltaic design or efficiency trade-offs. In other words, the easiest phase of optimization has likely already occurred, and future reductions may be slower or more limited in scope. At the same time, industrial demand is not defined by solar alone. Other sectors are also contributing to the overall consumption profile. High-performance electronics, data infrastructure, and advanced computing systems continue to rely on silver for its electrical conductivity and thermal properties. As digital infrastructure expands globally, especially in data-heavy applications, this adds another layer of demand that is less visible in mainstream discussions but still structurally important. There is also a shift occurring within investment-related demand. Physical silver demand from retail buyers in the form of coins and bars has shown periods of strength during volatility spikes. In some cases, this demand increases when prices decline sharply, as investors view lower levels as potential accumulation zones. This behavior does not necessarily offset industrial demand, but it does contribute to tightening physical availability during periods of market stress. When combining these demand components together, the picture becomes more balanced than a simple narrative of weakening consumption. Instead of a broad collapse in demand, what is actually occurring is a redistribution. Some segments are reducing intensity due to cost pressures, while others are expanding due to technological and industrial growth trends. The net effect is more stable than it appears when viewed through a single sector lens. While the demand side is evolving, the supply side remains structurally constrained, and this imbalance is what continues to define the broader market framework. However, despite this long-term structure, short-term price behavior is still heavily influenced by macroeconomic forces, particularly inflation dynamics and central bank policy expectations. Recent inflation data has reinforced the idea that price pressures remain persistent in certain parts of the economy. Producer-level inflation readings have remained elevated, reflecting continued cost pressures in upstream supply chains. These types of readings are particularly important for financial markets because they influence expectations about future monetary policy decisions. Central banks respond not only to current inflation levels but also to the trajectory of inflation over time. When inflation remains elevated or reaccelerates, it reduces the likelihood of near-term policy easing. Instead, it supports a more restrictive stance for a longer period. This has direct implications for assets like silver because it affects real yields and currency strength. Real yields represent the inflation-adjusted return on government bonds, and they play a central role in determining the opportunity cost of holding non-yielding assets. When real yields rise, holding assets like silver becomes less attractive in relative terms. When real yields fall, the relative attractiveness increases. This relationship is one of the key drivers behind short-term volatility in precious metals markets. Currency strength adds another layer to this dynamic. A stronger US dollar tends to exert downward pressure on commodity prices because most commodities are priced in dollars globally. When the dollar strengthens due to higher rate expectations or risk-off sentiment, silver often experiences short-term selling pressure even if physical market conditions remain unchanged. These macro forces converge around central bank communication, particularly policy meetings and forward guidance. The market is highly sensitive to language that signals either persistence in restrictive policy or potential shifts toward easing. Even subtle changes in tone can lead to significant repositioning across futures markets, which then translates into rapid price movements in silver. This is why periods of macro uncertainty often produce sharp volatility in silver prices that may not align with long-term supply-demand fundamentals. The paper market reacts quickly to new information, while the physical market adjusts more slowly. This mismatch is one of the defining characteristics of the current environment. Technically, this has resulted in a market that is currently in a consolidation phase following a sharp decline from recent highs. The price moved aggressively from the low 70s toward the low 60s in a relatively short period, reflecting macro-driven selling rather than gradual structural deterioration. After reaching support levels, the market stabilized and entered a consolidation range in the mid-60s. Momentum indicators have reset to neutral conditions, suggesting that the aggressive selling phase has temporarily exhausted itself. However, there is still no clear directional confirmation from buyers, which leaves the market in a state of equilibrium between competing forces. On one side, macro pressure remains present. On the other side, physical demand zones are beginning to emerge as potential support. Key technical levels define this structure. Resistance is concentrated in the upper 60s to low 70s range, while support is anchored near recent lows where physical buying interest previously appeared. The interaction between these levels and upcoming macro catalysts will likely determine the next significant directional move. What makes this phase particularly important is that it represents a compression of energy within the market structure. When price moves sharply in one direction and then stabilizes without establishing a new trend, it often indicates that the market is waiting for an external trigger. That trigger is typically macroeconomic in nature, such as policy communication, inflation surprises, or shifts in rate expectations. In the current environment, the Federal Reserve remains the most influential external driver. Market participants are closely focused on upcoming policy signals, not because they expect immediate changes in interest rates, but because they are looking for clues about the future trajectory of monetary conditions. These expectations directly influence both real yields and currency strength, which in turn feed back into silver pricing. Until a clear signal emerges, the market is likely to remain in this compressed state, where volatility is driven more by reaction than by sustained directional conviction. This sets the stage for the final phase of the analysis, which focuses on how structural and macro forces interact when the market reaches a point of decision, and what that means for the potential resolution of the current imbalance. When a market remains compressed like this for an extended period, it is usually because neither side of the equation has fully taken control. In silver's case, the balance is not between two equal forces in a simple sense, but between two different systems operating on different timelines. The physical market is slow, structural, and cumulative. The paper market is fast, reactive, and sentiment-driven. When those two systems point in different directions, price does not resolve immediately. Instead, it oscillates within a narrowing range until an external catalyst forces alignment. That is the state silver is in today. On one side, the physical market continues to reflect years of structural deficit conditions. Consumption has repeatedly exceeded production, and the gap has been covered by drawing down above-ground inventories. Those inventories are not infinite. Each year of deficit reduces the remaining buffer, and each withdrawal makes the next period of shortage more sensitive to disruption. Over time, this creates a situation where the market becomes increasingly dependent on financial pricing stability to avoid exposing physical tightness. On the other side, the paper market is still dominated by macroeconomic forces. Inflation data, interest rate expectations, currency strength, and geopolitical developments are all feeding into short-term positioning. Traders react quickly to new information, which means that even in a structurally tight market, prices can move lower if macro conditions support risk reduction. This does not invalidate the physical story, but it can delay its impact on price. The most recent price action reflects exactly this tension. After a sharp decline from the low 70s into the low 60s, silver found support and stabilized. That stabilization occurred in a zone where physical demand historically becomes more sensitive, particularly from industrial users and longer-term participants. Once price reached that area, selling momentum slowed, and the market entered consolidation rather than continuing its downward trajectory. This behavior is important because it suggests that physical demand is still active at lower levels. When price declines too far too quickly, it tends to trigger buying interest from participants who are focused on long-term consumption needs rather than short-term trading conditions. This creates a natural balancing mechanism that prevents unlimited downside movement, even in periods of macro-driven pressure. However, that support is not guaranteed to hold indefinitely. Its strength depends on the broader financial environment. If macro conditions remain restrictive, with elevated real yields and a strong currency environment, then paper market pressure can still overwhelm physical demand in the short term. If conditions stabilize or shift toward easing, then physical demand has a greater opportunity to influence price direction more directly. This is why upcoming monetary policy communication remains so important. It is not about whether interest rates move immediately. It is about how markets interpret the future path of policy. A more restrictive outlook strengthens the case for continued short-term pressure on silver through financial channels. A more balanced or neutral outlook allows structural factors to reassert themselves more quickly. What makes silver unique in this environment is that structural deficits do not disappear during periods of macro pressure. The projected imbalance of tens of millions of ounces per year remains in place regardless of short-term price action. The cumulative drawdown of inventories also continues regardless of sentiment. This creates a situation where the underlying condition of the market slowly tightens even while price can remain under pressure temporarily. Eventually, this divergence reaches a point where pricing must adjust more aggressively. The timing of that adjustment is not determined by fundamentals alone. It is determined by when macro conditions stop suppressing the signal coming from the physical market. When that happens, price tends to move quickly because positioning has already been built around the assumption of continued stability. From a structural perspective, silver is currently sitting in a transition zone between these two regimes. The first regime is one where macro forces dominate, and price reacts primarily to financial conditions. The second is one where physical constraints become more visible in pricing behavior. The market is not fully in either regime at this moment. Instead, it is moving between them. The technical structure reflects this transition clearly. Resistance remains defined in the upper range of recent trading activity, while support has formed near the area where physical buyers previously stepped in. The narrowing range between these levels indicates that volatility is being compressed. Compression phases like this are often precursors to larger directional moves, not because of speculation, but because energy builds when opposing forces remain active without resolution. In these conditions, the catalyst does not need to be large in absolute terms. It only needs to shift expectations. A change in inflation interpretation, a shift in central bank language, or a move in real yields can be enough to tilt the balance. Once that shift occurs, the market often exits the compression phase quickly, moving toward whichever side has stronger underlying momentum at that moment. If macro conditions ease even slightly, silver has room to reprice toward higher resistance zones, where previous highs become relevant again. If macro conditions tighten further, then lower support levels will be tested more seriously, and the durability of physical demand will be challenged under stronger financial pressure. In both cases, the move is likely to be more decisive than recent price action suggests, because compressed markets do not remain neutral for long once a trigger appears. What is important to understand is that neither outcome changes the long-term structural picture. The supply deficit remains in place. Inventory drawdowns continue to accumulate over time. Industrial demand continues to evolve rather than disappear. These factors operate independently of short-term market cycles. What changes in the short term is only the speed at which price reflects those underlying conditions. In many ways, the current environment is less about direction and more about timing. The structural story has already been established. The question is when the pricing mechanism fully reflects it. That delay between structure and price is where volatility is created, and it is also where most of the uncertainty in the market comes from. For participants observing the market from the outside, this phase can appear confusing because price movements do not always align with long-term narratives. However, for markets that operate under both physical constraints and financial speculation, this type of divergence is normal. It is not a sign that the structural story is incorrect. It is a sign that the market is still in the process of adjusting to it. As the system moves forward, the key dynamic to watch is whether physical demand zones continue to absorb selling pressure effectively, and whether macro conditions begin to lose their dominance over pricing behavior. If that shift begins to occur, even gradually, it would signal that the compression phase is approaching resolution. Until then, silver remains in a delicate balance between two competing forces. One reflects long-term scarcity building beneath the surface. The other reflects short-term financial pressure shaping immediate price action. When these forces finally align, the resulting movement is unlikely to be subtle because both sides of the market are already fully engaged in opposite directions. That is the underlying condition defining silver today, a structurally tightening system temporarily held in place by macro-driven volatility, waiting for the point where price can no longer remain neutral between them. And when that point arrives, the adjustment tends to be swift because the imbalance has already been building for multiple years beneath the surface of the market.